Hey guys, welcome back to the Another Excuse podcast. I'm your host, Byron Greeley, and today's guest is Andrew Borovsky, the founder of Visible. Visible is a company that aims to create a financial network for real estate. They're aiming to simplify real estate transactions and make them easier, faster, and cheaper. And the first way they're doing this is through a product called RentApp. And RentApp is a platform that simplifies rent payments and help renters build credit. It's a really interesting platform, and we discuss how and why he's going after such a huge and established market. And he has some really interesting answers. In the episode, we discuss his experience starting businesses, as he's started 3 of them at different stages in his life, and how his risk tolerance has sort of evolved and changed, and how his responsibilities have coincided with that. It's really, really interesting. And we talk about building a necessary team, what he looks for when he works at other companies or previous companies, and how he brings those people on board for new projects. And he shares some really good entrepreneurial wisdom that I think you're going to find really, really valuable. Enjoy the show. Thanks for joining me today. I'm really looking forward to our conversation. So to kick us off, could you tell us a bit about Visible and how it all works?
Sure. Visible is a company we started 2 years ago. I started with some folks that I've previously worked at Square and Cadre, my 2 former companies. The goal is very broad. The mission is to create this financial network for real estate. But we're kind of, nipping at different parts of it. So basically, the way I looked at it is everything, all the money movement adjacent to real estate is quite broken. So whether you're buying or selling, investing, borrowing against, or monetizing, real estate's awesome because you can do all these different things. Every one of those use cases is quite complex. And there's probably 3 vectors that people generally associate with it. One is it's complex. 2 is it's time consuming, and 3, it's usually costly. There's all the fees. And so the kind of really high level mission of the company is to try and tackle all 3. Let's make things easier, faster, and cheaper.
Cool. And so one of the products you guys have built so far is RentApp. How does RentApp work in that ecosystem?
Yeah, so as I mentioned, like the mission is very broad. Is you have to start somewhere as a company, right? So we built a bunch of foundational technology around real estate, and I should mention, I think you're based in Europe, and so the problems, technical problems associated with real estate ownership are they're different. They're definitely less pronounced than in the U.S. because the U.S., relatively speaking, the irony is that it's one of the most sought after real estate markets, but it's also one of the oldest, I guess. In a sense, private ownership sort of more or less really started here. And as a result, like you look at Eastern Europe and things are like a lot more technically capable there because it's one of the last markets to become private. We built the foundation, and then we wanted to tackle a use case. And it's very difficult, right? Because you talk about, when people think about real estate, buying and selling comes to mind right off the bat. But those are also like the most complicated things to tackle as a very small company, right? With limited funding. Borrowing, for example, is challenging because of the fact that, you need to be a lender and you have a lending license, and, it's a very, compliance heavy use case. And so you have to approach that kind of carefully. Monetizing was interesting to us, again, as we explored each one of them. So monetizing basically means I own real estate and it's an income property, right? Which is what you associate with rent. And there, it just kind of caught our eye for 2 reasons. One is it's quite big, right? So about 1/3 of all real estate in the United States is for rent. Okay, cool. That's quite a bit. I mean, money movement, right? About $600 billion annually paid in rent. So, massive GPV there, potential. And then, okay, what are the problems? Well, it's actually largely analog. So in the United States, a lot of rental properties are owned by individuals. There's got a long tail of ownership. And those individuals tend to collect rent using cash and checks. It's one of the last, big bastions of cash usage in the United States. And so, okay, great. Like that seems like there's something we can solve there, right? Let's figure out why people are using cash and checks. It's obviously inconvenient. And, what can we do, to simplify, again, make things easier, faster, and cheaper. And RentUp does all of that. Yeah.
Wow. It seems like this is, well, you've touched on it. It's a really big industry, and in tandem with that, a really big opportunity. But it seems like a huge undertaking. Was it not daunting at all, or were you very confident in going after this huge sort of archaic industry?
Yeah, I think I've had quite a bit of experience. My first foray into payments was with Square. Now that's 2012, so was that 12 years ago? And yeah, I think when I first entered the field, I was extremely intimidated by just kind of how things work, banking networks, but then fast forward sort of 3-4 years, and I realized that it's okay, you can kind of figure it out. And then actually, it's funny, it's that drive that led me to Cadre, which is this kind of tech-enabled real estate private equity platform. I was just, my background's a designer, so I was like, okay, private equity, PE is a scary word I heard, my whole life. And then, commercial real estate, and what is that? Alternative assets, right? And like funds that go in and invest via different vehicles into these really massive assets. And it all felt really intimidating, which is why I kind of wanted to get involved. And lo and behold, it's a similar thing. You can kind of wrap your head around most of the key mechanisms of private equity and kind of commercial real estate, in probably about a space of 6 months. I mean, I'm not saying I've perfected it. There's guys and girls out there that work on this and learn something new for decades. But you get 80% there, fairly quickly. And so having been through that effectively in the last 12 years, I just kind of don't get intimidated anymore, because there's certainly tons of blind spots, that I have, and I'm learning something all the time. But I think maybe versus when I was much younger, I just now I know that if there's something I don't understand, I can figure it out. And yeah, you just kind of nibble at it.
Yeah, that's having conversations with many entrepreneurs. That's a very common trait, where it's just like, I can figure this out, and it doesn't seem too daunting. But this may be me just making an assumption here, but it feels like disrupting an industry with so many large players who are making a shitload of money from the way things are might push back on someone coming into the industry and sort of disrupting it in a way. Have you noticed that at all?
Yeah, look, you have to be thoughtful about it. In real estate in particular, we get into things in the, again, very US centric thing, but like title, which is at the heart of a lot of the challenges. And for those that don't know, title is just sort of like the deed that you have to your piece of property. It's something that, an official document records that you own it, right? It's provenance, basically. And in the US, it's quite archaic. The system is largely analog. It's at a county level. There's 3,600 counties in the US. But it's a very lucrative business where you pay, when you buy, so when you do anything in real estate, you pay a whole bunch of, sort of key folks in the process that, I guess, lubricate the transaction more or less. And there's so much, because it's a massive asset class. There's so much money to be made just around title insurance, title search, title transfer, and it's all regulated on a state level. And there's a lot of lobbying to ensure that sort of things don't really, progress, too quickly, because again, there's so much money to be made. I think you just have to be thoughtful about it. Certainly, just kind of running through walls here is probably not the wisest thing, especially if you're a startup and you have to kind of conserve your strengths and you don't want to bang yourself against a wall that's maybe too thick, early on. So I mean, it kind of gets into the calculus, right? Like as a seed stage startup, we focused again on rent app. That's part of the reasons, like renting. Well, I don't want to say it's not regulated, but it's there's much lighter regulation around rent payments. There's a lot of regulation. I should put this. There's a lot of regulation around like tenant landlord relations. That's in every country, but we stay out of that. We're kind of the payments layer, and it's much easier to build something massive. Where in a space where it's loosely regulated. And then what happens is it's much easier to then tackle bigger problems once you have scale. I mean, real estate, at scale is something that, really respects, might. Like it's much harder for a very small player to make a dent in that space. But it becomes progressively easier as you're bigger. And so, for example, the way I look at Rent App, right? My goal ultimately is to be in aggregate one of the largest landlords in the United States, right? Which you can do because more than half of all real estate is owned by individuals. If we can aggregate all the individuals using our payment network, it's kind of actually it's a great example is like Uber, right, or Airbnb. Uber and Airbnb are not the world's largest owners of cars or houses, but they're the largest kind of conglomerate of vehicle owners and house owners, and so they really have the scale, right, to affect. I mean, remember when people tried to kick Uber out of all these different cities, and suddenly when they have millions of customers that love that product, it's much easier for them to go and like fight the city of London, right, to try and get what they sort of want, because they can get into this whole like, look, we're protecting sort of consumers here, et cetera, et cetera. So it's a very similar space, right? But it's a well-defined sort of playbook. I think you try and go the path of least resistance, you get scale, and then you're able to progressively take on bigger and bigger players in the space.
Yeah, that makes sense.
Mm-hmm.
And what's your guys' approach to getting people on the platform, getting homeowners to use the product? Obviously, it's a no-brainer in terms of it's way easier and more fluid, but like there's still a stickiness.
Yeah, you need the stickiness. Well, actually, I'll say this. The nice thing about rent payments is they're inherently sticky because of the fact that people pay every month and an average lease is 2 years. So that's actually kind of, on our side. So, there's a convenience factor. Like in any service, that's what they first try to tackle is convenience. What we found is it's interesting as a renter writing a check or paying with cash. If you do it once a month, maybe the convenience of doing that digitally is not that big a deal because it's just one payment. On the landlord side, it suddenly becomes a bigger issue because even if you're collecting for 3 properties, imagine if you take cash for one and maybe Venmo for another and then a check for the third one, suddenly you're having to juggle all these different things. So being able to standardize on a platform, is much more valuable. So we've had to really think about the renter. What can we offer there? And one of the cool things about Rent App is it helps you build credit. So if you, one of the big issues is you really don't get to build credit in the United States. Actually, I'm not sure how it is in Europe, frankly, but in the United States, right, you need to be kind of transacting, and those transactions tend to need to be debt. So whether you have a credit card, or a mortgage, right, it sort of becomes progressively easier to build credit as you take out debt. The problem is you can't take out debt without having credit. So a lot of people in their 20s, they kind of get stuck, right? And so you look at, something like 80% of all 25-year-olds in the United States rent. And they have debit cards, which are not debt. So what you have is just like fantastic numbers of college graduates that are not building credit. And as, rates have gone up and as real estate has gotten more expensive, that opportunity to build credit, let's say with mortgage payments, is, it seems further and further away. So we actually integrated with all the major credit bureaus, and I should say kudos to them because they've been increasingly open to new types of financial products qualifying for credit building. But yeah, in our case, if you pay rent using RentApp, you get to build credit like you would with a mortgage. So that's one carrot, right? That's it resonates. Obviously, we went out there with that marketing message, and people are like, yes, this is very meaningful to me, short term and especially long term. And that's one kind of added bonus on top of the convenience factor. And then we just recently, actually this week, launched a brand new feature that people really seem to love, and that's the ability to pay rent in two payments. So rather than having this balloon payment on the first, you pay rent on the first and the 15th. And so it creates two smaller rent payments that are better aligned with your paychecks, because most people get paid twice a month. And what happens is, if you're, I'm sure you remember it if you had to do it. Everyone remembers these horror stories, right? Where you're saving up, you're budgeting towards the first because you have this immovable object, which is your housing payment that you can't really shift. And you actually shift everything else in your life, everything from delaying purchases, and like not eating, to, sometimes using a credit card or getting a payday advance, to hit that, first of the month. And so what we call the product is called Split Pay. And it's a very easy way to, just streamline your cash flow. And so between Split Pay and credit building, suddenly RentApp is like really just a much better way to pay rent. Yeah.
Yeah, that's amazing. And what excites you about this huge problem that you're tackling at the moment?
Well, I actually just really I've always loved the consumer space is just, it's always rewarding to build products, because you just have the feedback loop, right? Is just very, very short. You can get something out there and you can get it in front of regular people and they use it, and if they enjoy it, they tell you that they like it, right? And that's just such a great thing versus and I'm comparing it to basically enterprise products, right? If you're building something, tons of stuff you can do in the B2B space, it just doesn't have the same, it doesn't feel as rewarding. You're usually, selling to, procurement officers and they're not using their own money. You just don't get the same kind of visceral reaction to the product. And then it's worth noting that again, with RentApp, what we really are trying to do, right, is also provide, I should mention, if you're an institutional owner of real estate, so if you own like 1,000-unit building in New York, you usually have a lot of technology. These guys, some of the property managers and institutional property managers, they sit there in front of 4 screens like traders, where they have a piece of software that manages, rental applications, payments, maintenance requests, all sorts of things. It's actually it looks like you're piloting a starship. So these guys are actually very well taken care of. Software tends to go into enterprise and institutional space first, and the long tail of small business owners tends to be serviced last, because they're just harder to aggregate. It's much easier to sell a piece of software to one very large client, and go to lunch, than it is to get the same scale by selling to 100 smaller clients. And this is what I really loved about Square, because Square was small business software, payments for small businesses. And so RentApp is payments for small landlords, right? People that own 2 or 3 properties, but they're actually the backbone of the country, right? Again, they own more than half of all real estate, about 55%. So I also love building products for small businesses, because similarly to you get that really fast feedback loop with a consumer. With a small business, you get this really fast growth. Like a small business, if you're able to build something really wonderful for a small business, they can double in a year, right? And you could watch that and be a part of that doubling, right? You're not going to double the size of BlackRock or a Brookfield, right? They kind of grow at whatever, a couple of percentage points a year. So I really love that too, because there's just seeing small business grow in real time is really cool and really rewarding.
That is cool.
Yeah.
And so you've started 3 businesses at 3 different stages in your life. Could you tell us a bit about the other 2 businesses and how they work?
Yeah, I mean, I started business in basically my 20s, my 30s, my 40s. Um, so yeah, I guess it's kind of almost like once a decade. But it's such a, I think what you build during a certain age is such a reflection of that age. Right. So, in my 20s, I kind of stumbled into it. I built the first company when I was, 28 in 2008, which is, the financial crisis. And it's not like I was, people say, oh, you got to build stuff during financial crisis because it's like the greatest opportunities. That's not why I built it. That's not like I actually was just so young that I was not even really aware of the fact that there was a financial crisis. It just seems that, when you're 28, like economic cycles just don't even really, they don't affect you the
Impact you.
same way.
Yeah.
Yeah. You feel like kind of on a different level. And so, I had this arrogance to leave where I was at the time, which was Apple actually. And so that was like, again, in retrospect, like, why would you leave Apple? I was doing super, super well there. And, but, it was just really, that kind of youthful enthusiasm and arrogance. And what's interesting there is just like kind of like shot for the moon. Like we wanted to build our own device. So we got into hardware and software. The device had its own operating system. I mean, I had no experience in bringing a product to market. I had no experience with distribution, building hardware or building operating systems necessarily. I was a product designer, so I knew I was one vertical at Apple, right, which was the user experience, but I never like did the whole widget. And so it was the arrogance, right, that kind of drives you to do really crazy things. But the cool thing about it is just like when you do crazy things, kind of this is kind of the main point behind your podcast, right? In some ways, right? Which is the kind of this, this overcoming fear, overcoming excuses, right? When you do things that are super, super crazy without even thinking about it, what happens is, well, you may not reach the kind of like the zeniths, right? Of like, you may not actually end up building the thing you're trying to build. But guess what? Like you'll probably get like 80% there, and 80% to a crazy thing is like not a bad place, And so we kind of did the same thing. We ended up, trying to build one thing and build something else. And it was equally kind of interesting and cool in a different way. And then we built this really good team and we knew a thing or two about like some adjacent kind of industries. And lo and behold, we ended up selling the company to Square, which was not how we ended up, how we thought about it. That was not the exit strategy. It was all like a total surprise. But this is what's awesome, right? About just like taking a leap is like, there's never a world where you take a leap and you fall into like, what do you call that?
A crevice or
a crevice or whatever. The abyss. You don't fall into the abyss, right? You just don't, you will land somewhere. You just don't quite know where you'll land. Which is why you should always make the leap, because wherever you're going to land is going to be a new and interesting and exciting place. So that was the mindset, and that was the outcome, I think, in a lot of ways. And then the second business I built in my 30s, kind of in some ways like really drunk with success, because it was such an amazing thing to build something when you're 28 and then exit when you're 32. That by the time I wanted to build a new thing kind of 4 years later, which was the kind of tech-enabled real estate private equity platform, I dove into it thinking I can do no wrong, right? It's like, it's a different type of arrogance, like a shittier kind in some ways, right? Where you're much less aware of your blind spots, right? And so I went in there, taking on maybe too much. Too much responsibility in a space that in a role that maybe I was not as well prepared for yet. Like I needed a few more cycles, to, really kind of do the next thing. So that was much more challenging, right? And that was a real wake up call. And, that business did okay. Like we ended up acquiring like $5 billion worth of assets. We ended up, merging with another company that did really well in that space called Yield Street. Cadre's there right now. I still manage my real estate investments through Cadre, but it's certainly, it was a much longer journey. I mean, that company is now 8 years old. It was just really, you went through multiple fundraising, rounds, we got much more diluted. It was not easy. It was not one of those like cakewalk things where you just go like straight up, at a 4-year mark, you like IPO or you sell the company. So, that was the lesson learned for sure.
Yeah, that's amazing. And I like to focus on the first business. It was 80/20, right?
Mm-hmm. Yes.
Why do you think that business was so successful?
Well, look, it was a different kind of business. I have to caveat this because it's maybe an unfair advantage. Like Cadre and Visible, right? RentApp, these are both like classic venture funded businesses, right? So you raise money and the idea is you can build a team and scale it to something completely massive. 80/20 was much more of like your typical small business, right? So it was a consulting business. The consulting business was, we had the skill, myself and the co-founders, we were really good product designers with, in 2008, a lot of experience. There's product design as a vertical is a very recent thing. It's really, it was built on top of the App Store effectively, right? On top of the rise of the iPhone, which in 2008 was just released. And so product design in 2008 was very different than product design in 2018, for example. And, but we were very lucky because we knew what we were doing back in 2008. And so we got, we were like at the right place at the right time where we built really complicated products for really big companies. Like we built Google Maps, which is, Google Maps for mobile, I should say. This is the user experience. If you open Google Maps on mobile today, that's actually the UI paradigm we came up with, back in 2010. We did big projects for like France Telecom and Vodafone and Verizon. Notice those are all telecoms, but telecoms ruled the day in 2008. We designed the last mobile phone that Nokia created, actually their smartphone it's a Migo based smartphone called the N9. That was right before they got acquired by Microsoft. So we got to, it was kind of a very niche business, but with really kind of elite products and elite companies that would recruit us on a kind of retainer basis. And so we built this really high margin product consultancy where, with 20 people, we did the work that maybe 200 people would do. And we would frequently compete with product, if you know companies like Frog Design or IDEO, we tended to go up against them. And these are companies with hundreds of employees. And so our margins were really, really good. So it was a different kind of business, built much more like more like a small business with really good margins, right? Which is different than a venture-backed business where you usually have terrible margins, but you have massive scale. So,
right.
Yeah,
that makes sense.
Yeah.
And you touched on it a bit earlier where you left Apple to sort of start 80/20.
Yeah.
But what led you to take that leap from being like a lead product designer to starting your own agency?
Yeah, it's similar to kind of what led me to do all three companies, which is at some point you just kind of go, hey, I think I want this thing to exist, which makes sense. I mean, I think proper entrepreneurs will say, by proper, I mean like, successful people that have been able to build a product that people want to use, and built a company around it. They're usually driven by an idea for something that they want to exist in this world. And so every time I left Apple, I really wanted to build, we built this one. I really wanted to build this a thin client, like this little tiny feature phone, kind of like the anti-iPhone at the time, which just came out, right? The idea was like, can I build like a $15 phone that is almost as capable as an iPhone, which was at the time a $500 phone. So it's a very specific thing that I wanted to build. And I was like, the only way I can build this is on my own. Right. And it's the same thing with Cadre. I was like, I really want to build this one thing, which was this, that was a democratized access to commercial real estate. Only wealthy people, super wealthy people really have access to the best commercial real estate deals out there. And it's this amazing asset class. And like, I really wanted to build this platform where regular people like my parents can go and invest in the types of deals that like Blackstone would invest in, right? Which was like, I wanted to see that in the world. And with Visible, it's the same thing. It's like, I've just been in real estate and payments for so long. I'm like, there's so many gaps. I just want to like fill it. And the only way to do this is to do it yourself. So I feel like that motivation has been very consistent. I think that's the right and the only type of motivation you should have when you're starting a company, because it's so hard. You need to be passionate about something to do it.
Yeah, but I think there's like a level of confidence needed in yourself, because I think there's millions of people out there who have problems and they want to solve them and even think that they're close to doing it, but they don't have the balls to actually like jump into it. And would you say that you're more confident in your abilities than like the average person, or is it something you've worked on over time? How did you develop that?
No, it's a really good question. I'm just thinking about it now. I do think I'm a little bit better positioned because I'm a product designer by trade. So I worked, at Adobe and in Apple, right? Which are these two big kind of product, and Apple in particular, like, I mean, I sort of came of age when Steve Jobs came back in 97. And then that whole journey to essentially, I joined Apple in early 2007, so fully 10 years later. And so I'm part of this kind of generation that watched Steve Jobs like create something out of nothing. And I watched, the iPod come out, the iMac, the iPod, and then the iPhone. And as a product designer, I was just really in the thick of what it means to create these products. And so I think I was just really, Apple made me believe that it's at the very least I was exposed to how these things are built. And so I knew that it's not like, don't get me wrong, it's complicated to build them, but it's possible to build great products. And then it's possible, like great companies follow great products. If you build a good product, you can usually then build a great company around it. I think there's just like a Johnny Ive interview. I keep seeing it. It just came out. And he was talking about how when Steve Jobs came back in 97 and they were working on the iMac, that they were like, their goal was not to save the company. Their goal was to build a really nice computer, which was the iMac, and the company will save itself as a consequence. And it sounds a little cheesy, but I actually think they really meant it. Like they really wanted to create a really great computer, and they fully believe that everything else will follow. So I think I'm just like, as a product designer, I've been exposed to that mindset by then for about 10 years. And so when you leave Apple, also it's the greatest company on planet Earth. So when you leave Apple, you're kind of, again, you're filled with this arrogance, like, I can do it too. Like, why couldn't I just make this thing? Whereas I understand the fact that, like, look, if you were, whatever, if you're in construction or you're a car mechanic, like it's a little harder to go, okay, I'm going to do something completely different. Like it's a bigger leap. I think if you worked in a garage or if you worked in construction, it's much easier to go, okay, I can start my own construction company or build my own garage, but it's maybe not obvious to you that you can build a digital product. But to me, that's like the obvious next step. So, yeah.
Yeah, that makes sense. And I'm curious, was the name 80/20 for the company based on the Simple Phone? Is that why you chose that name?
No, actually, there was two companies. The Simple Phone was called Sonar.
Okay.
Yeah, it's funny. You can dig it up. There was we actually went to Mobile World Congress, which was this conference in Barcelona. It took place every year. That used to be like where phones are revealed, that before the iPhone and before Android. And we actually demoed the product that we built to Engadget. Engadget's still around, right? I'm not sure, actually.
I'm not sure.
Okay, Engadget was like, because it was Engadget, and I think Engadget became The Verge. The Verge, presumably. Yeah,
Yeah.
and then what Gizmodo? It was like Engadget, Gizmodo, and Verge. They were like the original pioneers of like cool products get released on those platforms. And so we did a Engadget interview, and there's actually like a video out there. I think you could find it of me like demoing the product because it was quite impressive. Those guys really liked it. There's a very long Engadget article on kind of what we released, and that was called Sonar. And 80/20 was the consultancy that we stood up in order to bootstrap Sonar. So we didn't take any venture funding. We actually, just worked to pay for the product, which is still something. If people don't do that as often these days, I think because there's abundance of venture capital. But certainly, if you can bootstrap your business, man, what an exit that is.
Yeah. And speaking of venture funding at the moment,
yeah,
do you think that it's taken a bit of a shift after the AI boom and there's not that much venture funding available as there used to be like at the beginning of this AI boom?
well,
First of
all, I'd say like we're still. I mean, I don't think we're after the AI boom. We're very much in the middle of it. We're probably scratching the surface of what truly like people think right now. AI peaked. I think we're like 10% into where it's actually going to end up because you're seeing a lot of toys. So it's moving so fast. You've not actually seen it like alter industries, and it absolutely will alter industries. And so we're very early. I think maybe the better comparison is like crypto, because crypto as a technology, right? It's payments technology or store of value movement technology. I look at it very technically. Really cool tech. Is it like revolutionary on the level of AI? I actually don't think so. Like Web3, crypto, all those concepts are really, really incredible, and they will absolutely change global finance, and asset ownership and everything else. Like everything will be crypto 100%. But I think it's just like better rails, faster, more programmable rails. It's almost like a new programming language versus AI is like really like life altering shit, you know? So in that sense, like there was a huge, huge kind of jump into funding everything that's crypto, and that subsided to some extent. And I don't think it's going to like ever double. I think it might get to the same level, but probably won't be like 10x. Whereas I think AI will be 10x from here. Yeah, look, I definitely see it. I mean, we raised during the crypto boom, and there's a crypto element of what we're doing, just because if you're doing payments, you have to have a crypto. You have to think about, 10 years ahead into like where payments rails are going. And so, yeah, like I think we're pitching our business at a time where it was much easier to say the word blockchain and raise money than it is right now. Right now, it's actually like, it is probably detrimental. Right. Even though, again, that industry has not at all like fulfilled its promise yet. People are naturally less inclined to invest in things that are trying to do something with the blockchain. I don't think it's, again, because AI is like, we're still in very early innings. I'm not really seeing anything subside. I think people are, look, venture capital. I mean, it's capital, right? These are not people that build the technologies, right? If they could build them, they would not be in venture capital. They'd be out there building it. So it's very important to understand, like, what makes somebody a good venture capitalist is very different than what makes somebody a really good founder, right? So it's the marriage of these two things. And so venture capital, their biggest issue right now is just coming up with an algorithm of sorts of which AI companies and which blockchain companies are actually best positioned to succeed. So it's not that I don't think anyone's questioning the thesis of crypto or the thesis of AI. I think the scramble is around, okay, what types of teams and what types of founders are best positioned to succeed in these new verticals? And that's really hard. That's their main job, right? It's like to identify that talent. So it's not like, I don't think that it's as connected, I guess, to the narrative.
Yeah. That makes sense.
Yeah.
So you'd say that like the team and the founder is way more important than the idea itself?
Yeah. I mean, I think, I'm probably not the first person to say this. I think that's kind of common wisdom. Because ideas need to be, you raise money because you're trying to build something, because you want to throw it out there, you want it to collide with the market, and you want to see how the market reacts. And you're, as a seed stage company, you're trying to find product market fit. And some define product market fit as 1 million in ARR, which is, actually like a massive amount of money that you have to generate in revenue just to say that there's product market fit. So that takes a lot of time, right? To do all that. And so I'm saying it takes a long time to validate an idea. And so that's where you raise money for at first. And then, where the founder, I think, founding team, and the, well, not the founder, the founding team, I guess, where it really matters is if you have problems finding product market fit, you will need to, I don't want to say pivot, but you will need to endlessly refine this product until you do, right? All the way to a pivot is the most extreme thing you can do, right? But there's all these degrees from like, this is what we're raised money to do, and this is a pivot, but everything in between is what you do for those first 2 years, right? And so, a high quality founding team is really good at doing that, right? Whereas, somebody that's maybe less seasoned, is going to panic. They're going to build this beautiful, snowflake that they wanted to build, and they're going to throw it out there, and no one's going to want it, and they're going to panic. And that's actually the difference. I think the good VC companies, that's what they're kind of looking for. Like, is this team going to panic, right? And they feel really good when a company can not only adjust to the new information, but go all the way up to a pivot. That's almost the best investment, right? Like, if I can fund a team that's actually comfortable going all the way through to a pivot, well, what that means is like your money is, well, better off.
Yeah.
Right? Because that's at the end of the day, they're just trying to generate returns. So like, the idea is not enough. You need a team that can stick with it long enough to generate returns. Otherwise, it truly is spray and pray. You're just throwing money and it combusts instantly, right?
Yeah, true. And how do you go about building out your team, and has that approach changed over the 3 companies?
I think I've had a pretty consistent approach, and I've become more and more sure of my approach. And so again, I don't want to say mine. I'm like, lots of people have this approach. I'm just saying I share in this approach, which is that, you just got to hire the best people you've ever worked with. When I started the first company in 28, I looked at, in that case was 2 guys that I worked with at both Adobe and Apple, and we were a really great team. And the 3 of us had really, I like the number 3, because then you don't have this binary sort of tug and pull. 3, you can kind of have these conversations that are a little bit more informed, and you can have like majorities and decisions. And then we're quite different. Like, I was much more, we're all designers, but I was a little bit more on the biz dev side, and one of us was much more on the product design side, and one of us was much more operational. And so, that felt really good. And then, all the way through to now, actually started this company with the same 2 guys. So, we've now known each other, but I augmented it with some new folks that I've met over the period that we didn't work together. But this is why it's extremely important to nurture, cultivate, and invest in relationships at every stage of your career. Like, I look at every company, because I've worked at a lot of companies in the interim between having my own company, is I always look at every one of those sort of interim companies as places where I source, new people that I want to then become my co-founders, my founding, team. And so, you really got to think ahead. I always, when I meet somebody at a company, I try and, when I like them, I try and create a very personal, very direct relationship, because I assume that we're going to work together. Like, our friendship and our business relationship will transcend the company we're working for today. And ideally, you just constantly, like, you're building this team of Avengers, you're building this, perfect team, and you're just refining it. I can imagine that when I'm 60 and I'm starting a new company, like it will be the best people I've met in my 60-year, life. I think that's the best outcome, right? You're just, you're skipping a lot of stuff that otherwise would occupy you and getting to know people. Like getting to know someone to work with them, it's a lot of, there's actually an amazing number of companies out there where there's two co-founders that get into a fight in the first year and they like walk their separate ways. That is unbelievably common. And it's usually a consequence of the fact that, well, they've never worked together before. So I always lean towards, have I worked with this person before? That's the best signal. The interview is the worst signal. Yeah.
Yeah, that's really interesting. And going like a level lower on the org chart, like when you're hiring and building out the bigger team, what do you sort of look for people that will fit into the companies that you build?
Yeah, I mean, it's become a dirty word, culture fit. 4 years ago, during the height of like corporate wokeness, right? When we were doing all sorts of crazy things, during COVID, and we overreached, where the pendulum swings in both directions. But there was a lot of this sort of like, oh, you can't, I remember not being able to hire people. I mean, I've been in conversations where we're not allowed to look at people's photos or see their names.
Wow.
I think the craziest is potentially hiring people without looking at their portfolios, like, or work history, because even that's a bias. Like it really did get that crazy. I've been in the middle of it. And so, we're much better now. Like people have like readjusted. Now there's something about working from home. Everyone just like lost their minds. But now that we're back in the office, we realize the fact that, there is the right definition of culture fit, right? Which is that, people that just generally feel comfortable around each other, that share values and share, their approach and ethics. And so I think, I try and look for that. I try and really understand, what is the person's work style? Like, is it compatible how we work, right? At early stage, like you kind of, you do, the argument against culture fit was like, oh, you're creating very monolithic companies. And like, yes, I understand there's a danger of, you don't want to hire people that are identical to you, but I think you're trying to hire people where we complement them and they complement us. And that's a very loaded word. I know, Ken, I'm just constantly apologizing, but it's because it's a very nuanced thing. You have to be very thoughtful. It's a small group of people. It's sort of like, actually, here's a good example that I think everyone can understand, right? Like when you're throwing a dinner party, let's say for 10 people, you and, your significant other just said, hey, we're going to throw a dinner party. It's 10 people, right? Look, it's going to be an intimate event. 10 people and by the way, it's in your house. So probably most people, like 10 people is about the most that they can host, right? Like it gets kind of crazy. That's the largest table you can set up. So I'm sure you take some care to selecting the folks that you're going to get around that table, right? And we're talking about you probably select people among the people in your friend circle. You might know 30 people, but you try and find 10 people that are kind of going to get along and they're going to have a good time, right? They're going to have something to talk about. They're not going to, you're going to find people with similar temperament where like one side of the table is not screaming over the other, right? And you're going to seat them accordingly. So I think it's a very similar thing with startups, right? It's like your first 10 people, like it's like you're like having dinner, but like constantly, And so you gotta kind of think like, who do we already have? And how are the new people going to complement them? And are the people we're going to have, are we going to like talk over the people we're going to invite? Like it's a really curated experience. It becomes much more methodical and algorithmic after that. And you can start kind of inserting wild cards into it because the culture, the group of people is like resilient enough, right? That we can take in folks that are maybe a little bit more crazy. But that first 10 people is like, you got to curate it.
Yeah, that was well put.
Yeah.
And do you think entrepreneurship can be learned, or do you think it's innate in people?
I don't know. I like to think that everyone can learn how to do it. I mean, I kind of subscribe to this, whatever, 10,000 hours,
Yeah,
theory, and going back to like, I found myself learning very complicated things that are outside of my like, you know, strict kind of career track. This is my first CEO role. I felt like I was not ready to be CEO before I turned 40. I had to learn kind of around other people. But now I'm in like, I don't know, when I was 20, I never thought I could be a CEO. So I think everything can be learned. Mm. I guess I'm almost thinking like there's got to be people out there that have just a total aversion to entrepreneurship. And would I want to drag somebody like that along? Probably not. But I think if somebody doesn't feel like, oh, there's like, I just despise running my own business, too crazy. If you feel like kind of ambivalent about it and like the only thing you're missing is you just never done it, then I think everyone can learn. Yeah.
yeah, that makes sense. And
Yeah.
what's the 5-year plan for Visible?
Oh, it's yeah, you don't like in a startup, you don't want to do a 1 year plan because it's almost pointless. You can never see 1 year ahead. You can usually see like 3 months ahead and then 5 years ahead. So yeah, that's probably the right question. I mean, your 5 year plans at startups tend to be where that's where your mission,
Yeah,
tends to kind of float. And so I go back to, for me, I just have these three fundamental vectors around complexity, speed, and cost, um, as it relates to real estate. So, you know, and then most startups dive into indigestion. Again, not my quote. I don't know who said it first, but yeah. So you have to be, those the early years, the first 2 years of a startup's life is really about being hyper focused and very disciplined about not doing too many things at the same time, being very sequential. And so for us, it's okay. Rent app, get it to scale over the course of the next 6 to 12 months, and that then get it, make it something where you can call it a beachhead, right? A beachhead on this island of real estate, and then you try and figure out, okay, we secured the beachhead. Where do you go next, right? And so, for us, it's other use cases. We like this idea of borrowing against your real estate. That's something that's very common, very useful. A lot of people borrow against. By the way, people borrow against their real estate. There's actually, I believe, I'm not screwing the statistics, but when you think of home equity loans, right? When you get a loan against your home, it tends to be the number one reason is usually home improvement, and I
yeah.
think like number two, if not three, but I think almost number two is start a business. So there's a
Oh well,
lot of people that will use home equity loans as startup capital, and that makes total sense. And so, so I love to be in that space, right? Can we make it very easy for somebody with a click of a button to be able to borrow money against their real estate, this wonderful asset, and start a business? That's probably the next logical thing, and we'll see where it takes us from there. But I think as long as again we're delivering around very easy to use products that are very fast and very inexpensive to use, I feel like we're on track.
cool.
Yeah.
That's really cool. And before I end every conversation, I ask my guests if they have a question for me.
Oof. What I mean, just maybe going back to your what what's your excuse right now?
um, I'd say it's speed. I think I've come a long way since starting the podcast.
Yeah.
So I'm working on a few like business projects, speaking to a CTO, trying to look for a co-founder, kind of like speed dating at the
Okay.
moment,
Okay.
to be honest.
Cool.
Because I'm not technical, but I have an idea that I want to build out. So I'm in that process, but I'd say my excuse is I'm not moving as fast as I should be. And that's something I'm working on. I want to be someone who moves as fast as possible, makes decisions, and doesn't linger on them. So I'd say, yeah, that's my excuse at the moment.
No, it makes sense, and that's a good excuse. You're allowed to have that excuse. Maybe I actually circle back to like what you said before about AI. Like what's interesting because everything accelerates. One of the things that about AI in general that I think is really exciting is it'll lower the threshold for being able to get off your ass and do something. because I think, again, somebody said this. I'm sorry, I'm so bad with like attributing quotes to people, but AI makes it incredibly easy to start a company of one. Somebody mentioned about the fact that AI is gonna enable the first unicorn with an employee of one, right? Because it's virtually unheard of, right? And I think that's a really, really good way to think about it. Is because there's a lot of these things we think I need like at least 5 people or at least 10 people to get something off the ground, where that bar is much lower because you have these agents and you're able to do things all the way through to coding things, essentially by yourself. So that's really exciting. What I'm trying to say is that excuse of finding the right person to start a business with, it's gonna get smaller. Yeah.
Yeah, time is ticking for it to be an excuse any longer. I think I heard one of the creators I follow, Greg Eisenberg, has said that before. But I think quite a few people are saying that. Yeah,
that's a really good way to think about when you think about what the revolution, what the AI revolution is with regards to productivity and how it's going to change things. Yeah, it's going to enable these one-person companies that are doing the work of 100 people, which is incredibly awesome. That's a whole generation, whole new swaths of entrepreneurs that before, were blocked by their ability to recruit that 10 people or fund the 10 people.
Yeah, I agree. Well, thanks for joining me today, Andrew. I really appreciate it and really enjoyed the conversation. If people want to find out more about you and Visible, where can they do so?
Yeah, check out our product. It's rent.app. If you rent in the United States or if you collect rent payments, especially, we think it's truly the best way to both pay and collect rent. And we're constantly making it better. And that's rent.app, as I mentioned. I'm also Andrew at rent.app, so very easy to find me. Feel free to reach out. I love meeting new people, chatting about things, and we talk real estate, we talk entrepreneurship. I'm happy to see where each conversation goes.
Awesome. Thanks, Andrew.
Thank you.
Thanks for listening. I really appreciate you making it all the way to the end. I hope you enjoyed the episode. One more quick reminder before you go. I have a weekly newsletter by the same name, Another Excuse, where I cover 4 topics: something that has changed my perception, a tool that could be useful to you, content that is actually worth consuming, and a concept that I try break down and explain. If this sounds of any interest to you and you need a kick up the arse, then you can subscribe at the link below. Thanks for joining me again, and I'll see you next week.